My name is John Ross with Finance on a Budget. Do you know how to buy real estate for only $100? In this video, I'll show you exactly how to do it, and you won't even need to deal with tenants. Stick with me until the end, and I will give you 5 solid REITs worth looking into and possibly investing in. So please be sure to give this video a like, subscribe, and ring that notification bell. What is a real estate investment trust, or REIT? A real estate investment trust, or REIT, is defined as a company that owns, operates, or finances income generated in real estate. They are normally modeled after mutual funds, and because they are able to pool together investors' capital, they can offer dividends to investors from real estate without the actual need to buy and manage properties for themselves. How does this work exactly? REITs lease spaces and collect rent on properties. Afterwards, that income gets distributed as dividends to shareholders. The company should qualify as an REIT by complying with the Internal Revenue Code, IRC, which includes investing in at least 75% of its total assets in real estate, in U.S. Treasuries, or in cash. The company should also get at least 75% of gross income from rents, including interest and mortgage and real estate sales. What are the pros and cons of real estate investing? REITs are required to pay out at least 90% of income that they get as dividends. So as an investor, investing in an REIT means that you're guaranteed dividends. They also serve as an easy way for you to own real estate conveniently packaged into shares that you can easily buy and sell. The minimums are pretty low too, so it's easy to gain some exposure into real estate asset class even if you don't have a huge chunk of money laying around. This kind of passive interest gives you all the perks of owning real estate without actually having to manage them, relieving you of the stress that the property owners usually suffer through. Of course, this also means that you will inevitably be affected by declining property values too. The 90% requirement to distribute to shareholders is both a pro and a con in itself. After distribution of the dividends to investors, there's little capital left to acquire or renovate new properties. They are also taxed at your ordinary income rate. Yikes! So to keep you from losing all that money, try to invest in REITs in tax-deferred accounts, for example, an IRA or a 401k. How can you invest in REITs successfully? Simply open a brokerage account with Webull or Robinhood, links below, and you'll be able to buy and sell REITs like regular stock. Remember that as an REIT shareholder, you are responsible for paying taxes on the dividends as well as the capital gains you get. These REIT dividends are considered ordinary income, so you're not entitled to any reduced tax rates as you would with other corporate dividends. It's a good idea to consult with your tax advisor before you invest in REITs to make sure you know what you're getting into. Like I said, be sure to keep your REITs inside of tax-advantaged accounts like a self-managed IRA because of the large dividends. This way you can defer the tax on the distributions. Because REIT dividends aren't considered qualified dividends, they're not entitled to lower tax rates. They are, however, considered a pass-through business, so they can typically qualify for a 20% qualified business income, QBI, deduction. Receiving, say, $1,000 in ordinary dividends means that only $800 would actually be taxable. Be wary of the company's debt load, rising interest rates, and volatile prices in a hot market. How do you assess the value of REIT shares? Once you've decided on an REIT to invest in, you can then anticipate the growth in earnings per share. You can also determine the REIT value from the anticipated total return of the stock, which you can tell from the price change and the prevailing dividend yield. By the way, it's important to know how the REIT's current dividend yield is like compared to other yield-oriented investments like utility stocks, high-income investments, and bonds. The quality of the management along with the corporate structure, plus the underlying value of assets, should tell you whether or not your investment will perform well enough for you to get your money back with a significant growth. Or you could just look at the little up and down lines. If it goes up more than it goes down, you're probably good to go. What kind of REITs are there? There are different kinds of diversified and specialty REITs that can hold both office and retail properties in their portfolios. These are publicly traded REITs, public non-traded REITs, and private REITs. Publicly traded REITs are traded on the exchange and can be bought using ordinary brokerage account. They are more transparent and definitely faster than the more liquid way of owning property by yourself. Because public companies have lower management costs, they're more attractive than private companies that aren't subject subjected to disclosure and investor oversight. Public, non-traded REITs are also registered with the U.S. Securities and Exchange Commission, SEC, but you can't find them on the exchange. Only brokers that deal in public non-traded offerings can offer them, and as such, they can be very illiquid and difficult to value, and they also cost extra in management fees. Lastly, private REITs are unlisted and exempt from SEC regulation. Disclosure requirements are fewer and are normally only available to institutional investors like large pension funds. What REITs should I invest in? As promised, here are the 5 REITs that I personally own. They are held in my Webull IRA account and only took me seconds to set up. If you click my link below, you can get 1 to 3 free stocks depending on their current promotion. All you have to do is sign up and deposit just $100. Number 5, Realty Income. For some bizarre reason, their index code is O. I don't have an answer. It has seen some good growth over the past 5 years. After the market crash in March, it'll take some time for it to get back to full form. With a 4.94 dividend yield, it's not a bad starting place, with plenty of room to grow back in value. Number 4, Schwab IS REIT ETF, or SCHH. This is a very stable stock that has very gradual growth over the past 5 years. The dividend is only 3.65 and fairly low. It pays out quarterly, which is pretty common. Number 3, Crown Castle, code CCI, is more of a growth-oriented stock. At 3.95, it seems like a low dividend with Schwab. However, this leaves money back in the business to continue to grow. Number 2, Essex, ESS. They have been paying out for the past 25 years at 3.55%. Not bad, but be aware that the annual cost of living has gone up just as much, if not more, year after year. Number 1, Store Capital, STOR. This was doing really well until March when everything came down. However, they have made some solid movement upward since then. It has a really high dividend of 6.73, and that's why it's at the top of my list. Be aware that, as I mentioned, the more they pay out, the less they have to invest in future growth. If you're young and want to be a day trader, then look to growth stocks. I found these to be so volatile where one day they can make a ton of money and the next lose it all. This is called gambling. But if you're looking to invest money for retirement, then look no further than REITs that pay out predictable dividends. If you like this video, be sure to like, subscribe, and ring the bell notification. Thanks for watching.